ETF Structure Objective HCOW is an actively managed fund that invests in a portfolio of high free cash flow U.S. companies via the HCOW's ETF, then enhances income by writing individual covered call options on select holdings. The strategy seeks to deliver double-barreled monthly income while offering some drawdown buffer in flat or modestly bearish markets. Core components. 1. HCOW's ETF Core Equity Exposure. HCOW uses HCOW's as its base, which is built around FCF yield leaders, companies with strong operating cash flow relative to their market cap. These firms are less reliant on debt and more likely to sustain dividends during downturns. FCF is superior to earnings for dividend sustainability. Earnings can be managed, but cash is real. HCOW's sector tilt, as of 2025, utilities energy, 8.23%, consumer discretionary, 18% industrials healthcare, 25% tech, minimal exposure, reducing volatility. 2. Covered call overlay, alpha engine. HCOW sells individual call options, not index-wide, meaning it handpicks what to overwrite based on premium, volatility, and technical outlook. Focuses on at-the-money or slightly out-of-the-money calls with 30-45-day expiries. These calls typically generate 1-2% income monthly, annualized to TALHA 10-12%. Why this matters. Individual stock options offer better pricing and customization versus broad index calls. Targeted options avoid overwriting stocks with strong momentum, preserving more upside. Distribution mechanics. Dividends plus options, premiums collected throughout the month, distributed as monthly cash payouts to shareholders. NAV may drift slightly below par over time due to call capping and strong bull runs, risk-reward profile factor analysis. Volatility lower than QQQ or SPY due to option premiums offsetting downside moves. Upside potential capped due to calls, typically gains beyond 3-5% in a month are forfeited. Downside protection soft buffer via income generation but not a hedge fund, still long equities. Ideal conditions flat, choppy, or slightly bullish markets. Worst case scenario, prolonged bear market with collapsing dividends and weak options premiums. Tax considerations. Distributions may include ordinary income, option premiums, qualified dividends from HCOW stocks, return of capital if NAV erosion offsets payouts. This makes HCOW less tax efficient in taxable accounts, though the return of capital can defer taxes. Comparative positioning ETF yield strategy risk level growth cap HCOW 9. 6% dividend plus covered calls medium moderate JEPI, 8% SP 500 plus ELN slow med capped QLD, 11% full NASDAQ overwrite high heavily capped XYLD, 9% SP 500 overwrite med heavily capped. HCOW sits in a sweet spot between yield and customization, higher than JEPI, more selective than QILD, liquidity, growth potential, current AUM. 10M is very low, so large trades could cause slippage. However, Amplify ETFs has a strong track record with other funds, e.g. BLOK Devo. If HCOW gains traction with yield-seeking investors, AUM and volume could scale fast. Ideal investor profile. Looking for monthly income with moderate equity exposure, understands how covered calls limit upside, accepts lower capital appreciation in exchange for consistent yield, can tolerate NAV fluctuation but not full-on growth ETF volatility. Final word. HCOW is like a dividend machine with a safety belt. Not as aggressive as growth ETFs, but not as limited as income-only funds. Its dual income strategy is ideal for markets where growth is uncertain, but stability is valued.